Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I'm excited to be joined today by a return guest, Michael Roeder. Michael, welcome back to the show.
Thanks so much for having me on, Whitney. I really appreciate it.
Yeah, well, Michael, before we dive into Marvey Apartments, 310 units in the Dallas-Fort Worth area of Texas, tell us a little bit about yourself and how you got into multifamily and where you're at today.
Yeah, so I actually got my foothold in the real estate arena in the single family space in central Minnesota, where I grew up, and kind of fell into it. My wife and I, we've been married for 14 years. We were dating back then, and we decided we wanted to buy a 4 bedroom house. We were about 20 years old. So we rented out 3 of the bedrooms out of the 4 bedrooms, house hacked that first house, fell in love with the cash flow, and we started to accumulate single family rental properties. And started to suffer from some burnout pretty quick because I was doing all the maintenance, doing the leasing, the evictions, finding the properties. And at that time, my business partner, Dan Breezy, he was a professional snowboarder. He had been advised by his CPA to start buying apartment complexes. So he was buying anywhere from 10 to 30 unit apartment complexes, had third party management in place, that was overseeing the day-to-day operations. They were cash flowing really nicely. And so we ended up going into business together. We bought a 20 unit together, bought an 8 unit together. And then we formed our company about 7.5 years ago, Granite Towers Equity Group, and started syndicating projects that were larger, 100 plus units. So that way we could get some economies of scale and get into some better markets.
I love that. And, it's a journey that I can identify with. My husband and I, scaled 36. Well, first of all, we were living, flipping, and house hacking. And then we scaled a 36 unit rental property. And then I was like, wait a second, I don't have my time back like at all. And so not that you get it back as an active, operator of multifamily, but definitely you understand leverage. You can put an immense amount more of leverage on these larger projects, whether you're doing active or passive investing than you could with single family properties. So let's dive into the details of Marvey Apartments, 310 units, Dallas-Fort Worth area of Texas. When did you close on this property and what was the purchase price?
Yeah, so we closed on the property December 15th of 2023. So we're a few months in now. And, for anyone listening, whenever you have a December closing, that gets to be a little stressful because the bulk of the investors, whether you're investing yourself or you're raising capital, are looking to close, the year of the acquisition so they can get their depreciation write-offs. But we were able to close the property in under 60 days from when we went under contract on it. Like you said, it's located in Dallas, Texas, right by Dallas Love Field Airport. And we purchased it for right around $100K per door.
Okay. Yeah. And, for those of you who are listening, Texas is a non-disclosure state. So whenever we do have these properties that are closed in Texas, sometimes the numbers are like a band range or about. So that's why we don't get too specific. Well, okay. So you closed in the middle of December. I can certainly identify with it being tough to, get a deal closed and also raise capital in that time frame. But let's back up the timeline. And when did you find this deal? And, how did you find it?
Yeah, great question. So early October, the sales broker had approached us. We know them very well. We've bought a couple of deals from them in Dallas, Fort Worth. And, they thought it would be a good project for us based on our criteria that we had shared with them previously. It was a marketed property. So, fast forward when we actually offered on the property, there was about 5 different groups that went into the best and final round. We were not the highest bidder. We were actually about $500,000 lower than some of the top bidders. But right now, in our economy, in the real estate, stage that we're at right now, certainty of close is top priority for a lot of these brokers out there. And they knew that we'd be able to raise the capital, we'd be able to get past the finish line. Plus, on top of that, we knew the sellers really well. And anytime you can have a leg up like that, is certainly going to help you out with you getting awarded the deal. So we were awarded the deal. We raised, funds on this deal. It was a syndication, and we were able to get it done, well before year end. And just to share a little bit more on that, I've actually talked to quite a few brokers over the last few months, and I've heard about 50 to 70% of deals out there are falling out of contract because, general partners aren't able to raise the capital. So there's a lot of struggles in that arena. So again, certainty of close is absolutely crucial in today's environment.
Totally understand that. So I'm curious how you structured the contract on this because it sounds like you had a little bit of competition, even though that the deal was brought to you.
We did, yeah. So the contract, we had a pretty short due diligence period. We have a solid team that we know we can get in there and get done with the due diligence pretty quick. So we had about a week and a half due diligence period where the funds did not go hard until those dates passed. And, rewind, let's say a year and a half, 2 years ago, that would have been very tough to sneak in. Most of the deals that we were doing, that other syndicators and general partners were doing, there was hard money day one, of the PSA. Whereas this, we had a little bit of wiggle room so we could feel comfortable. And it's more so a buyer's market, so you're able to do that. We had a 60-day close period. So we had 60 days from the day we signed the PSA until the day that we had to close. And we always work into the PSA where we have at least two 15-day extensions. Typically, we have more hard money that goes up if we use those extensions. Very rarely do we use them. But you need a little bit of flexibility in case something comes up on title or the environmental study or, maybe your capital raise. You always want to have, that backup plan.
And how much did you put down for the earnest money on this project?
This one I'd have to take a look. I believe it was 1%. So, you're looking at about $300,000 down.
Okay. And was that out of pocket or did you raise that from investors? Because I think listeners are, especially people that are new to syndicating, are new to trying to buy larger multifamily deals. They're always wondering, how is the EMD fronted?
Yeah, so for us, it was a pool of funds from the general partners that were in on the deal. So myself, Dan, and then we had a couple other individuals that we had brought on as co-sponsors or co-general partners. I would say for people out there, if you don't have the funds for the earnest money, make sure to team up with someone that does, because you're going to need those funds. Plus, as a general partner, you're probably going to want to have a good amount of liquidity after you close for every single deal that you do, because you just never know what's going to happen with the deals, and you want to make sure that you have that liquidity in place just in case.
Absolutely. All right. So you got the property under contract. You have a week and a half to get the due diligence done. So tell us, how did due diligence go?
Yeah, on this one, due diligence went really well. So we had done the initial tour, and because we knew that we were going to offer on the property, we brought in one of our contractors, we brought our property management team, we brought our in-house asset manager. So we were very, very in tune with what was going on at the asset and the condition of the asset. And then during due diligence, we brought out all the trades. So you had a foundation expert, a roofing expert, plumbing expert. We scoped in all the water and sewer lines to make sure that there weren't major issues there. We walked every single unit. So our property management team, as well as our asset manager, walked every single unit so we can notate, what condition they were in, what upgrades they had. And we got that all done, within a week and a half. And the bulk, not all, but almost all of the bids that we, were collecting for our value add projects and for all the deferred maintenance, those were in within a week and a half. So we had a very good idea of what we were walking into.
So what was your overarching business plan with this property? You say value add, and it sounds like there's a little bit of physical, value add here, but tell us a little bit about the vintage of the property and what your vision was in order to produce value.
So this is a late 60s project. It was built in 1967, well taken care of, but there was definitely some deferred maintenance, as you would expect from an older asset. So we have about $4.2 million of CapEx that we're putting into this project. About half of it is for interior upgrades, and then the other half is for exterior and amenities. As far as the interior units, about 30 units have been fully upgraded. And then the other 280 units are classic units. So, we're putting about $10,000 per door into those 300 units and upgrading them as they come available. And then for the exterior, a couple of things that we're doing, doing a full paint on the exterior. We're redoing the kids' soccer field, which is going to look fantastic. They actually just started that this week. Redid the office, and the office is the first focal point when you come into these assets. Very, very important for prospective tenants and for current tenants. and it was very dated. So we redid the full office that's already been completed. And then some other deferred maintenance, carpentry around the asset, some cement work, some roofing projects and whatnot.
So tell us a little bit more about the due diligence. I'm wondering if there's any surprises, because oftentimes in the 1960s build, you usually get some sort of like, P-TEC in the plumbing, or, galvanized plumbing even. You get some sort of, there's issues with the breaker box, and, now you can't get insurance on the property. Did you have any of those surprises, or were all those issues already taken care of?
Yeah, great question. Not a lot of surprises on due diligence on this asset. Wiring was just fine. We had breakers in all the units, which was great. They actually had to replace those recently. Roofs were in pretty decent condition. Foundations were in great condition. The one thing that I would mention is we do have a significant amount of money slotted for plumbing. So anytime you have an older asset like this, a lot of times you have some galvanized steel, like you had mentioned, and that tends to erode, from the inside out. And so you're going to be digging up, on the exterior and sometimes on the interior, digging up those pipes and replacing them in, maybe 6, 8, 10-foot sections. And so we typically allocate a nice bucket of capital for that, because that's going to be consistent and it's not something that's typically going to go away after you replace a few leaks. So I would say that's the biggest thing. The water sewer scope went pretty well. There was a few bellies and a couple of breaks that we had to replace, but pretty standard. And then for HVAC, a lot of old units, but we did budget to replace the bulk of the HVAC units. And we're actually using a city rebate program where, we're getting about 50 to 60% off on those HVAC units as we install them. So it's a nice little value add there, and we're able to get some help from the city as well.
Tell me more about that, because I'm sure listeners would be intrigued to understand like how you even found that program, and how does one tap into something like that?
Yeah, so I would say two ways. Wherever you're investing, call the city, see if they have any rebate programs for new HVAC units. And a lot of times it's dependent upon the income levels in the area. So if you're in a high income area, you might not qualify for it. And then also talk to your HVAC professionals. A lot of these HVAC companies are in the know, and they're going to know what type of rebates are out there. And you can even do that before you take over on an asset. If you find an asset and you're thinking, gosh, we want to offer on this, do some calling around, and you should be able to figure that out pretty quick, but it can save hundreds of thousands of dollars. Plus, the other huge benefit is when you replace that HVAC or those HVAC units, it lowers your repair and maintenance cost. So your NOI is higher, which really drives the value of the asset up.
Well, and I wonder if that's attractive for the perspective, or, even the current tenant. Now their bills are lower. So that's a win-win for everybody for sure.
Yep. Bills are lower, plus, retention is higher too. I mean, you think about Texas, Dallas, Fort Worth, it gets really hot in the summer. And when you have a tenant where their AC goes out and maybe you can't get it fixed for a day or two, that's miserable. That's not fun. So retention goes up too.
I'm from the South, and I love my AC when I'm in the South,
Yes.
for sure.
I'm from
I
Minnesota
would
and it's
melt.
cold up here, but I still love my AC in the summer.
We actually just recently got AC in our home in Colorado. I'm like, after 15 years in this house, I'm like, what? Why did it take so long?
That's
Um,
amazing.
okay, so tell us a little bit about the financial due diligence on this property. Was all the paperwork in order, or how did that go?
It took a little bit to get all the leases. We were hopeful that we'd have all the leases during due diligence, and not all of them came through. So we had to underwrite, some of those after due diligence, but most of the paperwork was in order. However, we had to stay on top of the management company that was managing it prior to this. A few things that we look at, we take a look at all the contracts, obviously, make sure that we feel comfortable with everything that's in place. We also take a look at lease audits. We're auditing every single lease on the property, making sure that it matches up with the rent roll, taking a look at the occupations of the tenants, their income levels, all that fun stuff. And then you're obviously taking a look at, the historical financials, the T12, the rent roll, and just kind of seeing what the trends have done over the years. We also, typically request bank statements. On this one, we weren't able to get bank statements from the sellers, but sometimes you can sneak that in, especially in a buyer's market. So that way you can do even some more due diligence to verify that everything's accurate.
Yeah, but no like real surprises that would cause a retrade on the asset.
There were no surprises, and we did not retrade. And I know a lot of individuals are retrading out there. We've held to our word and we've never retraded on a project. And I think that's in part because we do a lot of due diligence upfront before we offer on the asset. But we also want to be known as the individuals that do exactly what they say they're going to do. And that's truthfully one of the reasons why we were selected for this project, is we've never retraded before. The brokers knew that, and they knew we'd be stand-up guys.
Awesome. So tell us how you financed this deal, especially, towards the end of the year, right? Like,
Yep.
if you did a traditional Fannie Mae or Freddie Mac loan, that's a little hard to close sometimes. So tell us what the financing was on this property.
Yep. So it was an agency loan. It was a Freddie Mac loan. We had just under 70% loan to value on the leverage. This was a 10-year loan, so we do plan on holding this asset a little bit longer. Interest only, we were able to get 5 years, and then the interest rate was in the mid sixes. 30-year amortization, and for us, we want to make sure that we're working with a really good originator or loan broker, because experience matters in that field. And then also, whenever the lender is asking for due diligence documents, we want to get those in pretty much instantaneously. We're doing a refinance right now, and the lender was just praising us for how quickly we get the documents in and how short the legal calls have to be, because there isn't a lot to go over. So if you're buying an asset, anytime that you can quicken the process on the general partnership side to get those documents in quicker, that really helps the timelines.
Awesome. And so were there any prepayment penalties, lockout periods? Is it a recourse loan? Tell us a little bit more about those details.
Yep, great question. So non-recourse loan, which is typically the case with any agency loans, there is yield maintenance on this. So, and that's something you want to pay attention to. If you plan on holding for a couple of years and you have, let's say, a 7-year loan, that's going to be really painful. Now, if you're planning on holding a little bit longer term, you may be okay with yield maintenance. So typically there's a few options for the prepayment penalties. On these agency loans, you have a step down prepayment penalty, which a lot of times will go 5% for the first 2 years, then 4%, then 3% every 2 years. Or you have yield maintenance, which, they calculate how much interest they're losing out on if you sell the asset early.
All right. Did you raise capital on this deal?
We did. So we raised about 16.9 million on this asset. Overall, the capital raise went well. However, looking back 2 years ago compared to now, a lot easier to raise capital 2 years ago compared to now. And I think that's just because there's a lot of negativity in the news, a lot of uncertainty. And whether that's in the stock market or, commercial real estate or single family, a lot of people, tend to hold tight to their money in the downturn. Whereas for us, this is one of the best opportunities to buy. Pricing on multifamily has come down 20 to 30%. We feel like we're at the bottom, especially with rate cuts likely coming down the pipeline later this year. And, I think a lot of limited partners just need to be educated on why now is the time to get in, and why, they should push those fears aside and put capital in today's environment.
Yeah, and I would 100% agree. And it's something I just recently released a book with Bigger Pockets, and talking about how to build and protect generational wealth. And private equity real estate, multifamily real estate, is huge at helping you build your wealth because it taps into 7 wealth pillars that you can't get with stocks, bonds, and mutual funds. So if you're a limited partner and that's where you're at, I encourage you, do your due diligence and consider that you can preserve your capital, you can create cash flow, grow your equity, take advantage of tax benefits. Those are the 4 major ways you can get paid in real estate. And then you can, if you have smart leverage on the property, you can amplify your growth that way. We also found out in the past 12 to 24 months, you can amplify your losses with poorly matched leverage. But leverage used wisely can be a 5th income generator. And those just aren't things you can get in the stocks, bond, and mutual fund world. And so, I encourage people, definitely take a look at that. You go back to, the famous quote by Baron Rothschild, like, buy when there's blood in the streets, even when the blood is your own, right? This is the time that people are going to make generational wealth, create that for themselves.
That's exactly right. It's, it's astonishing when the market is at its top, let's say a year and a half ago, and people are just so excited to jump in. They've seen the returns over the years. And then you get a market like today where pricing has dropped 20 to 30%. You have some great projections for rent growth coming down the pipeline a year or two from now. And you're putting the right debt in place, like you said, Whitney. You're putting likely fixed rate debt in place right now, which is really secure, and it's allowing you to kind of weather the storm. And a lot of people are nervous about jumping in. I think it should be the exact opposite. Take a look at the real estate cycles. You're never going to be able to time it perfectly, but if you can realize, when the market is up and when it's down, play to that effect.
Absolutely. And I don't want to neglect the fact that you still have to be in well vetted, invest with well vetted operators in fantastic markets in great deals, right? So it's not just, I'm not saying invest, period, right now. I'm saying invest wisely right now. And, the chances, the odds, to borrow a line from the Hunger Games, may the odds forever be in your favor on this. Um, Anyway, so let's talk about how you structured the capital stack or not the capital stack, but the actual the deal for the limited partners. Like, what kind of did you have a preferred return? Were there IRR hurdles involved? What was the back end split?
Yep, great question. So we typically do a straight split on all of our deals. So there's no return. There's no IRR hurdle. We do either a 75-25 or an 80-20 split. On this one, we did an 80-20 split. So 80% goes to the limited partners, 20% goes to the general partners. Projected returns on this one, about 87% over a 5-year period. And then cash on cash returns, which we typically do quarterly distributions. That was 5.5%. So very basic. And, obviously deals can get pretty complicated out there, but we keep it basic.
Nice. And what kind of fees did you charge the deal?
Yep, great question. So we have a couple of different fees. We do a 2% acquisition fee, and then we do a 1% disposition fee if we hit a certain hurdle. So we need to hit a certain return, which is typically in that 16% annualized range. And then we do a 2% asset management fee, and that's really to pay our payroll, for our employees that are helping run the deal. And then for management fee, we do use third-party management. We have a couple really good relationships. And for a deal of this size, we pay 3% to the management company for them, managing the day-to-day operations. And you'll see a pretty big spread, in management fee across the nation. But in Dallas, Fort Worth, if you have a 100+ unit apartment complex, you should be able to get a fee right around that 30%.
Now, I also want to dive into the general partnership structure a little bit. You have you and your partner, and then you said you brought on a couple of other general partners. How did you structure the general partnership?
Yeah, that's a great question. So, per the SEC, you have to be careful how you structure the partnership because you don't ever want to get into hot water, after you close on the deal. For us, we take a look at what value they're adding, whether it be on the capital raise, asset management, if they're signing on the loan, if they're putting hard money down, and then we allocate a certain part of the GP split or a small amount of the acquisition fee for those individuals coming on. Dan and I typically run all of our deals. So, we're the asset managers, we're taking the asset management fee and, a good portion of the general partnership split because we're finding the deal. We have the relationships, we're putting together the team, we're asset managing the deal, pretty much A to Z, but then we do bring in those couple of additional, co-general partners on each of our deals. And we always, make sure to integrate them into the weekly phone calls and the site visits and all of that fun stuff to make sure everyone's involved.
And so whenever you factor in the splits in the general partnership, how are you allocating what? I mean, you don't have to disclose exactly who's getting paid what, but like,
Yep.
how do you think through that allocation?
Yeah, again, it's based on value. So everyone's going to be a little bit different. If they're, let's say, putting up, a couple $100,000 hard, towards the good faith deposit or towards the earnest money. For that, we typically split off a portion of the acquisition fee. if they're coming on and they're raising capital and they're going to be on the weekly phone management calls and do site visits, then that's going to be a portion of the general partnership split. So again, hard to say, and it's not the same for every individual because each person brings in a different amount of value.
Mm. All right. So in wrapping up, what did you find easier on this deal? Or what did you think was going to be easier that actually ended up being a little bit harder? And what did you think was going to be harder that actually quite honestly ended up being easier?
Yeah, great question. So I can answer one of those very easily. Capital raise, bringing in $17 million in today's environment. We knew it was going to be tough, but we, probably underestimated how tough it was going to be. Looking back a couple of years, we typically raise that amount, within 5 business days or so. And it took us the full 60 days up until close to get the full amount in the door. So that was tougher. And then as far as what was easier, I would say the loan. The loan on this one was very simple. I think the lender really liked the deal. The occupancy was 98% plus. Delinquency was under $1,000 for a 310 unit property. So pretty much zero delinquency, which is something that we're really tuned into these days. And so the lending on this deal was actually really simple and went really quick.
Well, Michael, thank you so much for sharing your knowledge and expertise with us here today. If people want to find out more about you, how can they do so?
Yep, great. I appreciate you having us on or having me on. And if you go to granitetowersequitygroup.com, you can fill out the contact us form. We'll send you over our free passive investment tracker, and then we'll line up a call so we can have a further discussion.
Awesome. Well, again, Michael, thank you so much for sharing your time with us here today. We look forward to hearing about your future deals.
Thanks so much for having me on, Whitney. I had a blast. And thanks everyone for listening.